Chinese customs reports may not completely capture Iranian or Venezuelan oil volumes, since a portion is labeled falsely as Malaysian or Omani. Even so, the noticeable uptick in these arrivals suggests a deliberate push to leverage pricing gaps. A 2 percentage point alteration in import origins may sound minimal, but considering China's colossal energy appetite, it embodies billions of dollars rerouted and a significant shuffle of maritime trade routes. It also exerts downward pressure on traditional exporters like Saudi Arabia, Angola, and Brazil, occasionally prompting them to adjust official sale prices to protect market share. Wider consequences for global oil markets. China's evolving buying habits have sweeping repercussions for global energy balances. The expanding proportion of deeply discounted barrels from sanctioned sources raises doubts about the efficacy of Western sanctions and underscores loopholes that let oil keep flowing. By focusing on cheaper varieties, China can nudge worldwide benchmarks and sway market sentiment, particularly if this trend lingers. For many established suppliers, China's bargain hunting provokes competitive pricing responses, driving shifts in supply lines and contractual conditions. The situation is particularly delicate for Russia, a key OPEC+ participant, whose cut-rate exports to China can undermine group efforts to sustain higher price levels. Looking further, stronger partnerships between China and sanctioned oil producers could reshape global alliances, solidifying China's position as a crucial energy consumer prepared to work beyond Western-dictated norms. These moves not only secure lower-cost supplies for China, but also boost Beijing's leverage in global commerce and diplomacy, potentially laying groundwork for even more significant transformations in energy markets and international relations. Rise of electric vehicles and renewables. China is rapidly embracing electric vehicles, a trend directly affecting its oil demand. With a growing number of Chinese motorists choosing EVs and the government advancing electrification in transportation and industry, long-range oil requirements may wane. Additionally, the increasing proliferation of cleaner fuels, like LNG, further reduces reliance on oil-based energy sources. China's strategic economic alignment with BRICS countries, which are mainly the global producer of oil, has substantially reshaped global energy flows, particularly as Western nations impose sanctions tied to geopolitical disputes. The energy trade between China and Saudi Arabia has deepened significantly in recent years, evolving from a focus on oil to a broader collaboration encompassing renewable energy and technological investments. Saudi Arabia has consistently been a leading supplier of crude oil to China. In 2023, bilateral trade between the two nations reached approximately $107.23 billion, with a substantial portion attributed to oil exports. Beyond traditional hydrocarbons, both countries are investing in renewable energy. Saudi Arabia's Vision 2030 aims to diversify its energy mix, targeting 50% renewables by 2030. Chinese companies are instrumental in this transition. For example, in August 2024, China Energy Engineering signed a $972 million contract to build a 2-gigawatt photovoltaic solar power plant in Saudi Arabia, in partnership with Saudi entities including the Public Investment Fund and ACWA Power. Additionally, in July 2024, China's Sungrow Power Supply entered into an agreement with Saudi Arabia's Al Jihaz Holding to develop an energy storage project with a capacity of up to 7.8 gigawatt-hours, enhancing the stability of the kingdom's power grid. The financial relationship between China and Saudi Arabia is also strengthening. In November 2024, China selected Saudi Arabia for its first US dollar sovereign bond sale in 3 years, planning to issue up to $2 billion in dollar debt in Riyadh.